There is a promise. It's a quiet promise, made not in a boardroom or a shareholder meeting, but in the silent calculus of a customer's mind. It's the moment a person or a multinational corporation looks at a product or a service they use every single day and thinks, leaving this would be a nightmare. That single thought, that flicker of anticipated pain, is one of the most powerful and profitable forces in the global economy. It is the secret obsession of the world's greatest investor, the core of a philosophy that has compounded wealth at a rate that defies logic. Warren Buffett, over a career spanning more than 70 years, has not been hunting for brilliant inventions, flashy technology, or next quarter earnings beats. He has been hunting for this promise, the promise of the customer who will not, and more importantly, cannot leave. This is the principle of the switching cost moat. It is an invisible fortress built around a business, a barrier so high and so difficult to cross that customers become, for all intents and purposes, permanent. While the rest of the market chases growth at any cost, flitting from one hot stock to the next, Buffett seeks out these economic castles. He looks for businesses where the act of changing to a competitor is so expensive, so complicated, so disruptive, or so psychologically painful that the customer is effectively locked in. This isn't about trapping people, it's about becoming so essential, so deeply woven into the fabric of their lives or operations, that the alternative is unthinkable. The market, in its infinite and often misguided wisdom, makes a catastrophic mistake time and time again. It falls in love with the Me Too product, the company with a slightly faster chip, a marginally cheaper subscription, a new bell or whistle. It pours capital into businesses that must fight a bloody battle for every single customer, every single day, because their customers can and will leave for a nickel less or a feature more. This is a game of temporary victory, a treadmill of relentless spending on marketing and sales just to stand still. Buffett refuses to play. The financial transformation that occurs when you learn to see the world through this lens is profound. You stop being a speculator and you start being a business owner. Your focus shifts from the noise of the market to the quiet, predictable hum of recurring revenue. You develop an eye for sticky businesses, companies that aren't just selling a product but are selling a permanent solution. Your portfolio, once a collection of hopeful bets, becomes a fortress of its own, built from companies with virtually guaranteed sales, protected from the brutal winds of competition. You begin to understand what real wealth management is, not just picking stocks, but identifying and acquiring shares in businesses that have built an unbreachable competitive advantage. Today, we are not just going to talk about this principle. We are going to dissect it, internalize it, and forge it into a tool you can use for the rest of your investing life. We will explore the 5 distinct forms of this moat, the deep psychological triggers they exploit, and the exact financial fingerprints they leave on a company's balance sheet. This is the path to beating the market, not by outsmarting it in the short term, but by ignoring its frantic sprint and focusing on the inevitable marathon winners. This is the blueprint for financial freedom. This is the final promise. The first and most brutally effective form of this moat is what we can call the financial handcuffs. This is the most straightforward and tangible of all switching costs. It's when leaving a service or a product comes with a direct, explicit, and often painful monetary penalty. Think of the early termination fee on your cell phone contract, the capital gains tax you'd have to pay if you sold a long-held asset, or the sheer cost of ripping out and replacing a $1 million piece of industrial equipment. These are not subtle psychological nudges. They are cold, hard numbers on a spreadsheet that scream, "Stay put." Warren Buffett's understanding of this principle was on full display in one of the most dramatic and defining moments of his early career. A story that didn't involve a tech startup or a complex derivative, but a simple charge card and a mountain of salad oil. The year was 1963. American Express was a titan of the financial world, a symbol of trust and prestige. Its travelers' checks were as good as gold, and its charge card was a status symbol in the wallets of executives and globetrotters. But a storm was brewing in a place no one expected: Bayonne, New Jersey. A company called Allied Crude Vegetable Oil Refining, run by a charismatic fraudster named Tino DeAngelis, was a major customer of an American Express subsidiary that ran a warehousing business. This subsidiary would inspect a company's inventory, in this case, giant tanks of salad oil, and issue warehouse receipts against it. Other banks would then lend money to the company with those receipts as collateral. The system was built on the bedrock of American Express's reputation for integrity. But Tino DeAngelis had a secret. His tanks were mostly filled with seawater, with just a thin layer of salad oil floating on top. He had created a phantom inventory, securing hundreds of millions of dollars in loans against non-existent assets. When the fraud was discovered, Allied Crude collapsed overnight, defaulting on its loans. The banks, holding worthless warehouse receipts, turned to the parent company whose name was on them, American Express. The liability was estimated to be over $60 million, a catastrophic sum that threatened to wipe out the company's entire net worth. Wall Street panicked. The stock, which had been trading at over $60 a share, plummeted to $35. The consensus was that American Express was finished, a blue-chip company brought to its knees by a con man. This was the path of the 99%. See the headline, feel the fear, and sell. But Warren Buffett, then a young, relatively unknown fund manager in Omaha, did something different. He didn't just read the headlines, he went to work. He ignored the story about the salad oil and focused on the core business of the traveler's checks and the charge card. He wanted to understand their competitive advantage, their moat. He started visiting restaurants and airline ticket counters. He talked to cashiers and managers. He'd pull out his American Express card and ask a simple question. Are you thinking about stopping taking the card now that the company is in trouble? He would then pull out a competing card from a local bank and ask, why don't you just take this one instead? The answers he received were the key to everything. The merchants all told him the same thing. They couldn't stop taking the American Express card. Their best customers, the high-spending business travelers, all used it. To stop accepting the card would be to tell their most profitable clientele to go shop somewhere else. The financial cost of losing those customers was far, far greater than any risk associated with the salad oil scandal. In essence, the merchants were locked in by financial handcuffs. The choice wasn't between American Express and another card. It was between American Express and losing a significant chunk of their revenue. The customers, too, were locked in. The prestige and convenience of the card made it an indispensable tool for business and travel. The ecosystem was self-reinforcing. Buffett realized the market was catastrophically mispricing the company. It was valuing American Express based on a one-time, albeit massive, loss, while completely ignoring the indestructible moat around its core business. He put 40% of his partnership's capital into American Express stock, an absurdly concentrated bet that would make or break his young firm. Of course, he was right. The company weathered the storm, covered the losses, and the stock roared back, cementing Buffett's reputation as a genius. He didn't predict the future, he analyzed the present. He saw that the financial cost for merchants and users to switch away from American Express was simply too high. This single insight, born from old-fashioned shoe leather research, was a masterclass in identifying a business model fortified by financial handcuffs. The underlying psychological principle that makes these financial handcuffs so powerful is loss aversion. This is a cornerstone of behavioral economics, discovered by psychologists Daniel Kahneman and Amos Tversky. Their research proved that for human beings, the psychological pain of losing something is about twice as powerful as the pleasure of gaining something of equal value. Losing $100 feels much worse than finding $100 feels good. This cognitive bias is a relic of our evolutionary past. For our ancestors, losing a day's worth of food was a far more significant event than finding an extra day's worth. It was a matter of survival. Companies that build in financial switching costs are masterfully exploiting this deep-seated human trait. That $200 phone contract cancellation fee isn't just a number. Your brain processes it as a guaranteed, painful loss. The potential gain of switching to a new carrier, maybe saving $10 a month, is processed as a smaller, less certain pleasure. When you weigh the certain, immediate pain of the fee against the uncertain, delayed pleasure of the savings, your loss-averse brain screams, "Don't do it! It's not worth the risk." This is why businesses with these models can often get away with slightly higher prices or less than perfect service. The financial handcuffs create a powerful inertia. The customer looks at the cost to leave, feels that pang of anticipated loss, and decides to just stay put. It's the path of least psychological resistance. This principle is at the heart of so many successful business models, from enterprise software contracts with hefty penalties for early termination, to wealth management firms that have their clients' assets tied up in proprietary funds that would trigger significant tax events if liquidated. The cost isn't just a deterrent, it's a psychological weapon that short-circuits rational comparison and keeps the recurring revenue flowing. So how do we, as retail investors and entrepreneurs, translate this into a practical, repeatable process? We need an applied mental model, a blueprint for spotting these financial handcuffs in the wild. Let's call it the balance sheet handcuff audit. This is a step-by-step method for dissecting a company's financial reports, not for the numbers themselves, but for the story they tell about customer lock-in. Step 1 is to go directly to the company's annual report, the 10K. Ignore the glossy CEO letter and go straight to the business and risk factors sections. You are looking for specific keywords: long-term contracts, multi-year agreements, subscription-based revenue, deferred revenue, and backlog. When a company boasts about the average length of its customer contracts, that's a massive red flag for a strong moat. If a software as a service (SaaS) company reports that the average contract is 3 years long, they are telling you that a huge portion of their revenue is locked in and predictable. Step 2 is to scrutinize the balance sheet for a line item called deferred revenue or unearned revenue. This is a profoundly important and often misunderstood number. It represents cash that the company has already received from customers for services it has not yet delivered. It's the money from that 3-year contract paid up front. A large and growing deferred revenue balance is a direct financial indicator of customer commitment. It's a mountain of cash that proves customers are willing to pay far in advance, a clear sign they have no intention of switching. Step 3 is the concentration check. In the 10K, look for any discussion of customer concentration. Most people see high customer concentration, where 1 or 2 customers make up a large portion of revenue, as a risk, and it can be. But if a company has a 10-year contract with a Fortune 500 client that represents 30% of its revenue, you have to ask, what would it cost that client to rip out this company's product and replace it? The answer is often in the tens or hundreds of millions of dollars. In this context, concentration isn't just a risk, it's evidence of an incredibly deep and financially fortified relationship. Step 4 is to listen to the quarterly earnings calls. Don't just listen for revenue and earnings per share. Listen for the language that executives use. When they talk about metrics like net revenue retention or dollar-based net expansion rate, they are giving you a direct measure of switching costs. If this number is over 100%, it means the company is not only keeping its existing customers but is also selling them more stuff over time. This is the holy grail. It indicates the switching costs are so high that customers are not only staying but are also becoming more dependent on the product, further strengthening the financial handcuffs. This systematic audit transforms stock analysis from a guessing game into a forensic investigation, allowing you to identify the companies with the most predictable, locked-in streams of recurring revenue. The antithesis of this approach, the path that 99% of investors and entrepreneurs follow, is to become mesmerized by growth without questioning its quality. They chase what we can call the Groupon effect. For a time, Groupon was one of the fastest-growing companies in history. Its revenue growth was astronomical. Investors, seeing this top-line explosion, piled in, convinced it was the next big thing. But they failed to ask the fundamental question: what were the switching costs for Groupon's customers? For the small businesses offering the deals, the switching cost was zero. They could run a deal one day and never use the platform again. For the consumers buying the deals, the switching cost was also zero. They were loyal to the discount, not the platform. If a competitor offered a better deal, they would switch in a heartbeat. Groupon had built a massive business with no moat. It had to spend colossal amounts of money on marketing and sales just to acquire new customers who would then churn out just as quickly. The business model was a leaky bucket. When the growth inevitably slowed, the lack of customer retention became painfully obvious, and the stock collapsed, wiping out billions in shareholder value. This is the fate of any business built on a Me Too product that competes solely on price. Think of the dozens of food delivery apps, the countless fast fashion brands, or the generic electronics manufacturers. They are in a constant, bloody war for a customer base with no loyalty. The 99% investor sees a company that beat revenue estimates by 2% and buys the stock, without ever asking how much it costs to acquire that revenue and how likely that revenue is to return next year. The CEO mindset that falls into this trap is one focused on transactions, not relationships. They celebrate the new sale but have no system for measuring or valuing customer retention. They are on a treadmill, running faster and faster just to stay in the same place, and eventually, the treadmill always wins. The direct financial connection between the financial handcuffs moat and a company's performance is stark and undeniable. It creates a cascade of positive effects that flow directly to the bottom line and manifest as a superior long-term investment. First, it dramatically increases the lifetime value, LTV, of a customer. A business that has to reacquire its customers every year has a very low LTV. A business with a 5-year contract and high termination fees has an LTV that is orders of magnitude higher. Second, it drastically reduces the customer acquisition cost, CAC. Companies without a moat are in a marketing arms race, constantly bidding up the price of ads and sales commissions to attract fickle customers. Companies with high switching costs can spend less on marketing because their customers aren't going anywhere. This LTV-CAC ratio is one of the most important metrics for long-term business viability, and a financial moat sends it through the roof. This translates directly into higher profit margins. Less spending on sales and marketing means more money falls to the bottom line. Third, and most importantly for an investor like Buffett, it creates highly predictable cash flows. A portfolio of businesses with multi-year contracts and locked-in customers is a portfolio that generates cash like clockwork. This predictability allows for better capital allocation, confident dividend payments, and the ability to weather economic downturns far better than companies living hand-to-mouth on transactional sales. When you build a portfolio of these companies, you are essentially engineering the volatility out of your returns. You are no longer subject to the whims of consumer fads or competitive price wars. You are tapping into the powerful, consistent currents of recurring revenue, a financial advantage that, over time, is almost impossible to beat. The second great pillar of the switching cost moat is more subtle than a termination fee but often far more powerful. It is the insidious, entangling power of the procedural quicksand. This is the moat built not on direct financial penalties, but on the immense operational and logistical pain of making a change. It's when a product or service becomes so deeply embedded in a company's day-to-day workflows, its training manuals, and its institutional muscle memory, that the idea of switching becomes an organizational nightmare. The cost isn't measured in dollars on an invoice. It's measured in thousands of hours of lost productivity, the chaos of retraining an entire workforce, and the risk of catastrophic disruption to the core business. To understand the sheer scale of this moat, we must look at one of Warren Buffett's largest and most defining acquisitions, a company that deals not in software or microchips, but in steel, diesel, and the vast, unglamorous landscape of American industry. In 2009, in the smoldering ashes of the great financial crisis, Warren Buffett made the biggest bet of his life. Berkshire Hathaway announced it would acquire the entirety of the Burlington Northern Santa Fe Railway, BNSF, for an eye-watering $44 billion. To Wall Street, it seemed like a bizarre move. Railroads were old-world, capital-intensive, slow-growth businesses. The sexy money was flowing back into tech and finance. The path of the 99% was to dismiss this as an aging investor making a nostalgic bet on a bygone era. They saw smokestacks and unions. Buffett saw a fortress. He saw a business protected by one of the deepest procedural moats on the planet. Consider a company like a major grain producer in North Dakota. For decades, their entire logistical operation has been built around BNSF. Their silos are built alongside BNSF tracks. Their loading equipment is calibrated for BNSF railcars. Their shipping schedules are integrated with BNSF's timetable. Their staff knows the BNSF logistics team by name. Now imagine a competitor, New Rail Inc., shows up and offers to ship that grain for 5% less. For the grain producer's CEO to accept that offer, it's not a simple matter of signing a new contract. It would be an act of corporate self-destruction. They would have to reconfigure their entire supply chain. They might have to truck their grain miles away to a different rail line, assuming one even exists. They would have to retrain their entire logistics team on a new system, with new software, new contacts, and new procedures. Any hiccup in this transition, a delayed shipment, a lost car, could lead to millions of dollars in spoiled product or broken contracts with their own customers. The procedural cost of switching is not just an inconvenience, it is an existential risk to their business. Buffett understood this on a national scale. BNSF wasn't just a collection of tracks and trains. It was the circulatory system for a huge swath of the American economy. Thousands of businesses, from coal mines in Wyoming to ports in Los Angeles, had built their entire operational existence around the geography and procedures of the railroad. They were, for all practical purposes, permanent customers. BNSF's competitive advantage wasn't just its physical tracks, which are nearly impossible to replicate. It was the trillions of dollars and millions of man-hours that its customers had invested in integrating their own procedures with the railroads. This is the essence of procedural quicksand. The longer you use the service, the more you invest in processes around it, the deeper you sink, and the harder it becomes to ever pull yourself out. Buffett wasn't buying a transportation company. He was buying a permanent, indispensable piece of America's industrial infrastructure. He saw that the recurring revenue from these locked-in customers was as predictable and reliable as the tides. This CEO mindset, the ability to see beyond the product and analyze the customer's workflow, is what separates a good investor from a legendary one. He looked at a rusty old railroad and saw a business with customer retention metrics that would make any modern SaaS investing guru weep with envy. The psychological forces that make this procedural moat so effective are the status quo bias and its close cousin, cognitive dissonance. The status quo bias is our brain's powerful, built-in preference for the current state of affairs. Any change from our baseline is perceived as a loss, an effort, and a risk. Our brain's default setting is, if it ain't broke, don't fix it. This is an incredibly efficient mental shortcut. Evaluating new options takes energy, and our brains are lazy. Sticking with the current system, even if it's imperfect, requires zero mental effort. When a manager at a company considers switching from their current accounting software to a new one, they are not just evaluating features and price. Their brain is immediately confronted with the immense activation energy required for the change. The hassle of data migration, the groans from the accounting team who have to learn a new system, the weekend hours spent overseeing the transition, the risk of something going wrong during the busiest time of the quarter. The status quo bias magnifies all of these procedural hurdles, making the comfort of the familiar, albeit flawed, current system seem far more appealing. Then cognitive dissonance kicks in to seal the deal. This is the mental discomfort we feel when we hold two conflicting beliefs. Let's say a company has been using a particular supplier for 10 years. The decision to choose that supplier was made long ago, and the company has since invested millions of dollars and thousands of hours building processes around them. If a manager now has to admit that a new supplier is significantly better, it creates a dissonant thought. We made a bad decision and have been wasting resources for years. This is a painful and ego-threatening admission. To reduce this discomfort, the brain will actively fight against the new information. The manager will start to rationalize the old decision, overemphasizing the minor flaws of the new supplier while magnifying the supposed benefits of the incumbent. They'll say things like, "Our current system has its quirks, but we know how to work around them." Or, "This new vendor seems promising, but they don't really understand our unique needs." This isn't a conscious, logical process. It's a subconscious defense mechanism to protect their ego and justify past decisions. The combination of our natural laziness, status quo bias, and our need to feel like we've made smart choices in the past, cognitive dissonance, creates a nearly impenetrable psychological barrier to change, a barrier that smart companies use to lock in their customers for decades. How can a retail investor develop the CEO mindset needed to spot this powerful moat? You need a practical mental model. Let's create the workflow disruption map. This isn't about looking at financial statements. It's about thinking like an operations consultant. Step 1 is to choose a company and then deeply research its primary customers. Who are they? Are they small businesses or large enterprises? What industry are they in? Step 2 is to hypothesize the customer's core workflow. How does this company's product fit into their daily operations? For example, if you're analyzing a company like Intuit, the maker of QuickBooks, you would map out the workflow of a small business accountant. Their entire day revolves around that software: invoicing, payroll, expense tracking, tax preparation. It is the central nervous system of the business's finances. Step 3 is the crucial part: map the disruption. Create a detailed, step-by-step list of everything that an accountant would have to do to switch to a competing software. It would look something like this. 1. Research all competing software options, 10 to 20 hours. 2. Choose a new provider and sign a contract. 3. Export decades of financial data from QuickBooks. 4. Pray the data is compatible with the new system. 5. Manually clean and import the data, potentially hundreds of hours, high risk of error. 6. Reconfigure all bank account connections. 7. Recreate all custom invoice templates. 8. Retrain every employee who touches the financial system. Massive productivity loss. 9. Run 2 systems in parallel for a quarter to ensure no data is lost. 10. Hope the new system doesn't have a critical bug that brings the business to a halt. When you lay it out like this, the idea of saving a few $100s a year on subscription fees seems utterly insane. The procedural cost is immense. You can apply this map to any business. For an industrial parts supplier like MSC Industrial Direct, the map would include the cost for a factory manager to retrain mechanics on a new parts numbering system or reintegrate a new vendor into their automated inventory management system. By systematically mapping the pain of switching, you move beyond a superficial stock analysis and gain a deep, visceral understanding of a company's competitive advantage. The antithesis to this, the path of the 99%, is to fall for the trap of the better feature. This is the common mistake of investing in a company, simply because its product is technically superior on paper. The world of business is a graveyard of technically superior but commercially failed products. Why? Because their creators and investors completely underestimated the procedural quicksand entrenching the incumbent. A new startup might develop a database software that is 10% faster and 20% cheaper than the one made by Oracle. They will attract venture capital, and tech writers will praise their brilliant engineering, but they will fail to gain significant market share from large enterprise customers. The investors who backed them will lose everything. They forgot to map the disruption. For a Fortune 500 company to switch its core database, the risk is astronomical. Decades of critical applications have been built on top of the Oracle system. An entire department of highly paid database administrators is trained specifically on Oracle's architecture. A migration would be a multi-year, multi-million-dollar project with a significant chance of catastrophic failure that could take the entire company offline. The 10% performance gain is not even remotely worth the risk. The 99% investor looks at the new product spec sheet and sees a winner. The Buffett-style investor looks at the customer's workflow and sees an unbreakable moat. This is a crucial distinction for anyone interested in portfolio growth. Chasing features is a gamble. Investing in entrenched procedures is a high-probability bet on inertia. This mistake is particularly common among entrepreneurs with an engineering background. They develop a brilliant solution, but they fail to appreciate the non-technical, human, and procedural barriers to adoption. They have a CEO mindset focused on product, not on the customer's total cost of change. The direct financial connection of the procedural moat is incredibly powerful. Its primary effect is a dramatic reduction in customer churn. Companies with this moat often have churn rates below 1% annually, meaning they retain over 99% of their customers each year. This stability is the foundation of compounding growth. When you don't have to replace your customer base every few years, every new sale adds directly to the top line. This leads to immense pricing power. Once a customer is deep in the procedural quicksand, the provider can gradually increase prices year after year, and the customer will almost always pay it. Why? Because the cost of the price increase is minuscule compared to the massive procedural cost of switching. This is how a company like Oracle can maintain its dominant market share and sky-high profit margins, despite newer, cheaper competitors. The financial statements of a company with this moat will show remarkably consistent revenue growth and expanding operating margins over long periods. Their sales and marketing expenses, as a percentage of revenue, will often be lower than their competitors because they don't need to spend as much to keep their customers. They benefit from what is essentially an annuity-like stream of cash flow from a captive customer base. For an investor building a portfolio for long-term financial freedom, identifying companies with this procedural moat is like finding a golden goose. These businesses are cash-generating machines that are wonderfully insulated from the day-to-day chaos of the market, quietly compounding wealth for their owners year after year. The third pillar of the switching cost moat is a phenomenon of the modern age, but its roots are as old as commerce itself. It is the fortress of technological lock-in. This goes a step beyond procedural quicksand. It's not just about embedding in a workflow. It's about becoming the entire digital or physical ecosystem in which the customer operates. With a procedural moat, switching is difficult and painful. With a technological moat, switching is borderline impossible without starting your entire life or business over from scratch. It's when a suite of products, services, and platforms are so seamlessly integrated with each other that leaving one part of the system means giving up the benefits of the whole. This creates a gravitational pull that is almost irresistible. For the perfect illustration of this principle, we must turn to the single largest stock investment of Warren Buffett's career, a company he famously avoided for decades before finally understanding the true nature of its competitive advantage. For most of his life, Warren Buffett was a notorious technophobe. He famously quipped that he wouldn't invest in technology because he couldn't predict what it would look like in 10 years. He passed on Intel, he passed on Microsoft, and he passed on the initial rise of Apple. The path of the 99% during the 2000s was to mock Buffett as a man out of touch, a relic who didn't understand the new economy. But in 2016, Berkshire Hathaway began buying Apple stock, and they didn't just nibble. They bought and bought and bought until Apple became by far the largest single holding in their massive portfolio, a stake now worth well over $100 billion. What changed? Did Buffett suddenly learn to code? Did he start caring about screen resolution and processor speeds? No. He finally saw Apple not as a technology company, but as a consumer products company with the most brilliant technological moat ever constructed. One of his lieutenants, Ted Weschler, or Todd Combs, first brought the idea to him. But Buffett, as always, did his own research. He didn't look at PE ratios, he looked at his grandchildren. He watched how they lived inside the Apple ecosystem. They had an iPhone. Their music was on iTunes, their photos were on iCloud, their apps were from the App Store. They did their homework on a MacBook, which synced seamlessly with their phone. They wore an Apple Watch that unlocked their laptop. He realized that for these hundreds of millions of people, the iPhone was not just a phone. It was the remote control for their entire digital life. The thought of one of his grandchildren switching to an Android phone was laughable. It wouldn't just mean getting a new device. It would mean losing their music library, painstakingly transferring their photos, rebuying all their apps, losing all their saved passwords in the iCloud keychain, and disrupting the seamless flow of information between all their devices. The cost was not financial. It was a cost measured in identity, convenience, and digital history. The hardware, the iPhone itself, was just the gateway. The real product was the ecosystem. The true competitive advantage was the technological lock-in. Apple had created a beautiful, user-friendly prison. Once you were in, the walls were so high, and the life inside was so convenient, that you would never even think about trying to escape. Buffett stated publicly that he saw the iPhone as an incredibly sticky product. He understood that Apple's customers were not making a new purchasing decision every 2 years when their contract was up. The decision had already been made. The only question was which new model of iPhone they would get. This insight transformed his view of the company. He no longer saw it as a fickle hardware maker subject to the whims of fashion. He saw it as a toll booth on a digital highway that hundreds of millions of people traveled on every single day. This was a business model that exhibited the kind of predictability and customer retention he looked for in companies like Coca-Cola or American Express. The scale of the investment shows his conviction. He wasn't betting on the next iPhone, he was betting on the permanence of the ecosystem. The deep psychological principles that power this technological lock-in are the endowment effect and the sunk cost fallacy. The endowment effect, another concept from behavioral economics, describes our tendency to place a much higher value on things we own than on identical things we don't. In a classic experiment, participants were given a coffee mug and then offered the chance to sell it. The price they demanded was consistently more than twice what another group of participants, who were not given a mug, were willing to pay for it. Simple ownership creates a powerful, irrational attachment. For an Apple user, their iPhone is not just a phone, it's * my Thai phone. It holds my Thai pictures, my Thai contacts, my Thai life. The ecosystem becomes an extension of their personal identity. Asking them to switch to Android isn't just a practical question. It feels like a personal violation. They overvalue their current setup simply because it is theirs. This is then supercharged by the sunk cost fallacy. This is our tendency to continue with an endeavor, if we have already invested significant time, money, or effort in it, even if the current evidence suggests that stopping is the most rational choice. The past investment, which is gone forever, irrationally influences our future decisions. Every dollar a person spends in the App Store, every hour they spend organizing their photos in iCloud, every minute they spend creating a playlist on Apple Music, is a sunk cost. It's a little bit more cement poured at the base of their prison wall. When they consider switching, their brain doesn't just evaluate the new phone on its merits. It calculates all of that past investment, the money, the time, the emotional energy, and feels a powerful urge not to let it go to waste. I can't switch now, the thought goes. I've already spent so much money on these apps. Rationally, that money is gone whether they switch or not. But psychologically, switching feels like invalidating all that past effort. This potent combination of overvaluing what you have and refusing to abandon past investments creates a technological moat that is incredibly difficult for competitors to breach, even with a superior or cheaper product. So how can we, as retail investors, systematically identify these technological ecosystems? We need a blueprint. Let's call it the Ecosystem Dependency Checklist. It's a series of questions to ask about a company to gauge the strength of its technological lock-in. Question 1. Does the company sell a product or a platform? A product is a standalone item, a single piece of software, a single device. A platform is a foundation upon which other products and services are built. The Windows operating system is a platform. A word processor is a product. Salesforce is a platform. A simple contact manager is a product. Platforms are inherently stickier because customers build on top of them. Question 2. Are there high costs associated with data migration? Ask yourself, how difficult would it be for a customer to get their data out of this company's system and into a competitor's? For companies like Salesforce or the enterprise software giant Workday, this is a monumental task. A company's entire sales or HR history lives inside that platform. Extracting it is complex, risky, and expensive. This is a massive barrier to switching. Question 3. Is there a network effect? A network effect occurs when a product or service becomes more valuable as more people use it. The classic example is a social network like Facebook, but it applies elsewhere. The Apple App Store becomes more valuable to users because there are millions of developers building apps for it, and it becomes more valuable to developers because there are billions of users on it. This creates a powerful, self-reinforcing feedback loop that locks in both sides of the market. Question 4. Does the company sell high-margin add-ons? A strong ecosystem allows a company to sell its locked-in customers additional products and services at very high profit margins. Apple doesn't just sell you the iPhone. They sell you iCloud storage, Apple Music subscriptions, Apple Care warranties, and take a 30% cut of every app you buy. This is a key financial signature of a strong technological moat. It demonstrates a form of pricing power that goes beyond the initial purchase. By running a potential investment through this checklist, you can move beyond the hype of a single hot product and determine if the company has constructed a true, durable ecosystem, a business model designed for long-term portfolio growth and wealth management. The antithesis, the path of the 99%, is mistaking a popular product for a locked-in platform. This is a subtle but catastrophic error. Think back to the era of BlackBerry. For a time, it was the must-have device for business professionals. Its physical keyboard and secure messaging were beloved. Investors piled in, believing it was an unstoppable force. But BlackBerry sold a product, not an ecosystem. Its value was contained entirely within the device itself. It had no deep data lock-in, no real network effect in the modern sense, and no platform for developers to build upon. When the iPhone and Android came along with their vastly superior app ecosystems, there was nothing to keep BlackBerry users from switching. Yes, they loved their keyboard, but that was just a feature, a preference. It wasn't a true switching cost. The transition was relatively painless. They got a new phone, re-downloaded a few core apps, and their life continued. BlackBerry's market share evaporated in what felt like an instant. The stock collapsed. Investors who mistook its temporary product leadership for a durable moat were wiped out. The same story can be told for countless other companies: GoPro in cameras, Fitbit in fitness trackers. They all made popular products, but they failed to build the technological prison around their customers. The 99% investor gets excited by a product that is selling well now. The sophisticated investor with a CEO mindset asks, what will keep the customer buying that product 5 or 10 years from now? The answer is almost always the strength of the surrounding ecosystem. The direct financial connection of a technological moat is perhaps the most explosive of all. First, it enables the winner-take-all or winner-take-most dynamic. Because of the powerful network effects, the leading platform tends to attract the most users and developers, which in turn makes it even more attractive, creating a cycle that starves competitors of oxygen. This leads to incredible market share dominance, often exceeding 70% or 80%. Second, as we mentioned, it creates a goldmine of high-margin add-on sales. The initial product gets the customer into the ecosystem, and then the company can sell them a stream of digital goods, services, and subscriptions that have near-zero marginal cost and produce enormous profits. This is the financial engine behind the SaaS investing model. This is why Apple's services revenue is now larger than most Fortune 500 companies and is growing faster than its hardware sales. It's almost pure profit. Third, this moat creates a powerful brand identity that becomes a self-perpetuating marketing machine. People don't just use Apple products, they are Apple people. This identity-level loyalty is something traditional advertising can't buy. Financially, this manifests in sustained high growth rates, expanding profit margins, especially gross margins, as software and services become a larger part of the mix. and a massive amount of free cash flow. When you are looking for businesses that can truly compound your capital over the long term, searching for these technological ecosystems is one of the most effective strategies for achieving genuine financial freedom. The fourth pillar of this unbreachable fortress is the most human of them all. It's a moat built not of contracts, code, or procedures, but of trust, familiarity, and personal connection. This is the power of the relational glue. In a world increasingly dominated by algorithms and automation, it's easy to underestimate the sheer force of a strong human relationship. This is the switching cost that arises when a customer is loyal not just to a company or a brand, but to a specific person or team within that company. It's the trust you have in your longtime financial advisor, the comfort of working with a supplier who knows your business inside and out, or the simple human preference for a familiar face. Leaving doesn't just mean changing a vendor, it means breaking a trusted bond and starting over with a stranger. Warren Buffett, a man who deals in billions, has built his empire on his profound understanding of this deeply personal force. No story illustrates this better than his acquisition of a humble furniture store in Omaha, run by a tiny, indomitable Russian immigrant. The story of Berkshire Hathaway's purchase of Nebraska Furniture Mart is pure Buffett legend. The year was 1983. The store was run by Rose Blumkin, better known as Mrs. B. She was a force of nature. Having fled Russia with nothing, she arrived in America unable to speak a word of English. She started her business in a basement with a $500 loan, guided by a simple but unbreakable philosophy: sell cheap and tell the truth. Over the next several decades, she built Nebraska Furniture Mart into the single largest home furnishing store in the entire country, generating hundreds of millions of dollars in annual sales, all from one location in Omaha. Her competitors, with their fancy showrooms and slick salesmen, were mystified and terrified by her. She undersold everyone, yet made enormous profits through sheer volume and ruthless efficiency. Buffett, a longtime admirer and customer, decided he wanted to buy the company. He went to see Mrs. B, who was then nearly 90 years old. He asked her how much she wanted. She named a price, around $60 million. Buffett agreed on the spot. He didn't ask for an audit. He didn't have his lawyers comb through the books. The deal was done on a 2-page contract and a simple handshake. Why would a meticulous investor like Warren Buffett do such a thing? Because he understood that the company's real asset wasn't the inventory or the building. The asset was Mrs. B and the culture she had created. The moat around Nebraska Furniture Mart was the unbreakable relational glue between her and her customers. Generations of families in the Midwest bought their furniture from nowhere else. They didn't just go to the store to buy a sofa, they went to see Mrs. B. They trusted her implicitly. They knew she would give them the best price and stand behind her product. If a competitor opened up across the street and offered a sofa for $50 less, it wouldn't matter. The customer would still go to Mrs. B. The switching cost was emotional. Leaving would feel like a betrayal of a long-standing, trusted relationship. They weren't just buying furniture, they were participating in a local institution. Buffett knew that as long as that trust remained, the business was invincible. The story gets even better. After selling, Mrs. B continued to work at the store well into her hundreds. At one point, after a disagreement with her grandsons who were then running the business, she quit in a huff at the age of 103 and started a rival furniture store across the street called Mrs. B's Clearance and Factory Outlet to compete with the very business she had sold to Buffett. And she started stealing market share immediately. Buffett, with his characteristic humor and wisdom, not only supported her but eventually bought that new business from her as well. He knew her power. He was not investing in a retail business model, he was investing in a trust-based monopoly. This is the essence of relational glue, a competitive advantage so powerful it can't be measured on a balance sheet, but is worth more than all the physical assets combined. The underlying psychological principles that create this relational glue are the liking bias and social proof. The liking bias is one of the most straightforward and potent forces in human interaction. We are far more likely to say yes to and do business with people we know and like. This seems obvious, but its effect on commerce is profound. A skilled salesperson doesn't just sell features, they build rapport. A good consultant doesn't just deliver a report, they become a trusted advisor. This bias is triggered by several factors: physical attractiveness, similarity, we like people who are like us, compliments, and cooperation. A company whose culture encourages its employees to build genuine, long-term relationships with clients is systematically cultivating this bias. When a client considers switching to a new supplier, they aren't just comparing prices. In their mind, they are comparing a trusted friend and partner, the account manager they've worked with for a decade, to a faceless stranger from a competing firm. The liking bias creates an emotional hurdle that makes the logical choice, saving a little money, feel wrong. This is reinforced by social proof, the tendency to see an action as more appropriate when we see others doing it. When a relationship with a vendor has existed for a long time, it becomes its own form of social proof. The internal thought process is, we've been with this firm for 15 years. They must be good, otherwise we would have left long ago. The longevity of the relationship itself becomes evidence of its quality, making the decision to continue with it feel safe and validated. Think of the specialized wealth management advisor who has handled a family's finances for 3 generations. The trust passed down is a form of inherited social proof. The children trust the advisor because their parents trusted them. To fire this person would be to go against decades of family tradition and perceived wisdom. It's a decision fraught with emotional weight. This is why in many B2B industries, when a star salesperson leaves a company, they often take their biggest clients with them. The client's loyalty was never to the company's logo, it was to the individual. The relational glue was with the person, not the corporation. For entrepreneurs, this is a crucial lesson. In many businesses, the quality of your customer relationships is your primary competitive advantage. So how can we, from the outside, spot the presence of this powerful but intangible moat? We need an investor's blueprint. Let's call it the trust ledger analysis. This is a qualitative approach to sniffing out the signs of deep, institutional relationships. Step 1 is to analyze customer longevity. Companies with strong relational glue will often boast about it. Look in investor presentations, annual reports, and CEO interviews for any mention of the average customer lifespan. When a company says that its top 20 clients have been with them for an average of 15 years, you have found a giant flashing sign of a relational moat. Step 2 is to look for a high Net Promoter Score, or NPS. NPS is a metric that measures customer loyalty by asking one simple question. On a scale of 0 to 10, how likely are you to recommend our company to a friend or colleague? A consistently high NPS score is often a proxy for strong customer relationships and trust. While it's not a perfect measure, companies that obsess over it and consistently score well are usually doing something right on the relational front. Step 3 is to analyze the sales model. Does the company rely on an army of transactional, high-turnover salespeople? Or does it employ a smaller team of highly compensated, long-tenured consultants or relationship managers? The latter model is a strong indicator that the business is built on deep expertise and long-term trust, not just on moving product. This is common in specialized fields like investment banking, high-end consulting, and private wealth management. Step 4 is to look for evidence of a founder's culture. Just like with Mrs. B, is the founder still involved in the business? Do they still set the tone for customer interaction? A business where the founder's ethos of trust and customer service is still palpable often has a powerful relational moat that is very difficult for a sterile, professionally managed competitor to replicate. By using the trust ledger analysis, you can learn to read the subtle human clues that point to a business with an intensely loyal customer base, a key component of any successful long-term stock-picking strategy. The antithesis, the path of the 99%, is to fall for the fallacy that price is everything. This is the classic mistake made by spreadsheet-driven managers and investors who believe that human beings are perfectly rational economic actors. They build a business model or an investment thesis based on the assumption that if they offer a product that is 10% cheaper, customers will flock to their door. A new consulting firm opens up and undercuts the established players like McKinsey or Boston Consulting Group. They may win a few small projects, but they will struggle to land the massive, strategic contracts from Fortune 500 CEOs. Why? Because when a CEO is making a $10 million decision that could affect the future of their company, they are not primarily concerned with saving a few $100,000 on consulting fees. They are concerned with managing risk. They hire McKinsey because they have a 50-year relationship with the firm, they trust the senior partner who is advising them, and they know that if things go wrong, no one ever got fired for hiring McKinsey. The established firm isn't selling a report, they are selling trust and career insurance. The new, cheaper competitor is an unknown quantity. The relational glue and social proof surrounding the incumbent are too strong to be broken by a simple discount. The 99% entrepreneur focuses on undercutting the competition's price. The 99% investor buys the stock of that entrepreneur, believing the low price will guarantee market share. Both fail to appreciate that in many of the world's most profitable industries, the buying decision is driven by trust and emotion first, and price second. The direct financial connection of the relational glue moat is profound and durable. Its most important financial signature is lower than average sales and marketing expenses as a percentage of revenue. When a significant portion of your business comes from repeat customers and word-of-mouth referrals from those happy customers, you simply don't have to spend as much on advertising and cold calling. This leads directly to higher operating margins. Second, it provides a powerful defense against economic downturns. During a recession, businesses and consumers cut discretionary spending. They stop buying from new, unproven vendors. But they will fight to maintain their relationships with their most trusted, essential partners. The company with the strong relational moat will see its sales dip far less than its competitors who live on one-off transactions. This creates a much more stable and predictable revenue stream through the entire economic cycle. Third, it often leads to a form of organic, high-margin growth. Happy, loyal customers become your best salespeople. They provide testimonials, they refer their friends and colleagues, and they are often the first to buy your new products and services. This creates a virtuous cycle of growth that requires very little capital investment. For an investor, finding a business with a true relational moat is like discovering a well-oiled machine for compounding capital. It's a business model that replaces the brute force of marketing spend with the subtle, enduring power of human trust, creating a competitive advantage that is as profitable as it is difficult to replicate. The fifth and final pillar of the switching cost moat is perhaps the most insidious, because it operates almost entirely within the customer's own mind. It is a barrier built of fear, uncertainty, and doubt. This is the search and uncertainty penalty. This cost isn't a line item on a budget or a disruption to a workflow. It is the mental and emotional energy a customer must expend to even consider an alternative, and the terrifying risk that they might make the wrong choice. Every potential switch comes with two hidden costs: the cost of searching for a new option and the cost of the new option possibly being worse than the old one. In many cases, this psychological penalty is so high that the customer never even begins the search. They stick with the devil they know. No company in history has benefited more from this powerful force of consumer inertia than Warren Buffett's most famous and most successful investment. The story of Buffett and Coca-Cola is the quintessential tale of investing in a dominant brand. He first invested heavily in 1988, after the market crash of 1987, eventually committing over $1 billion to buy a significant stake in the company. To many on Wall Street, Coke was a mature, slow-growth business. The path of the 99% was to look for the next high-flying growth stock. But Buffett saw something else. He saw a product that had woven itself into the daily habits of billions of people, protected by a moat of pure psychological inertia. To understand this moat, consider the perspective of a small restaurant owner. Every day, they must decide which beverages to stock in their fountain machine. Coca-Cola comes to them and offers their flagship product. A new competitor, Sparkle Cola, comes and offers a similar tasting product for 10% less. The rational choice would seem to be Sparkle Cola, But the restaurant owner is paralyzed by the search and uncertainty penalty. First, the search cost. Do they really have time to research this new company? Are they reliable? Will their delivery trucks show up on time? It's a hassle they don't need. But the uncertainty penalty is far greater. They know that customers will come in and ask for a Coke. It is the default, generic term for a cola. If they offer Sparkle Cola instead, what happens? Will the customer be disappointed? Will they complain? Will they decide to go to the restaurant down the street next time because they know they can get a real Coke there? The potential upside of saving a few pennies per serving is dwarfed by the potential downside of alienating even a small percentage of their customers. The risk is simply not worth the reward. So they make the safe choice. They choose Coca-Cola. This dynamic plays out billions of times a day, all over the world. A person stands in front of a vending machine. They see a Coke and a dozen other unfamiliar brands. They have 2 seconds to make a decision. What do they choose? They choose the familiar, the predictable, the safe. They choose Coke. The mental energy required to evaluate the other options, weigh the risk of a bad taste, and make a new choice is a small but very real cost. Buffett saw that Coca-Cola wasn't just selling sugar water, it was selling certainty. It was selling the absence of a bad experience. This moat was put to the ultimate test in 1985 with the infamous New Coke fiasco. In a desperate attempt to combat Pepsi in blind taste tests, Coca-Cola's management made the catastrophic decision to change their classic formula. On paper, it made sense. The new formula consistently beat both old Coke and Pepsi in taste tests. But they had completely misunderstood their own moat. People didn't drink Coke because it was the objectively best-tasting cola. They drank it because it was Coke, a source of comfort, nostalgia, and predictability. The public backlash was immediate and volcanic. The company was inundated with protests and angry letters. People felt that a piece of their cultural heritage had been stolen. After just a few months, the company was forced into a humiliating retreat, reintroducing the original formula as Coca-Cola Classic. This monumental blunder was, ironically, the greatest thing that ever happened to the brand. It was a multi-billion-dollar advertisement that proved, beyond any doubt, that the bond between the customer and the product was not rational, but deeply emotional and psychological. The uncertainty of the new was so terrifying to consumers that they revolted. Buffett saw this not as a sign of management incompetence, but as the ultimate proof of the moat's indestructible power. He knew he had found a business whose customers were locked in by the very wiring of the human brain. The core psychological principles that create this penalty are choice paralysis and regret aversion. Choice paralysis is a phenomenon where having too many options actually makes it more difficult for us to make a decision. In a famous study, researchers set up a tasting booth for jam in a grocery store. On one day, they offered 24 different varieties of jam. On another day, they offered only 6. The booth with 24 jams attracted more people, but the booth with only 6 jams resulted in 10 times more actual sales. The overwhelming number of choices in the first scenario led most people to simply disengage and make no choice at all. This is what happens every day in the marketplace. A consumer is bombarded with thousands of messages from hundreds of brands. The easiest, most energy-efficient mental path is to simply tune it all out and stick with the familiar default option. The incumbent brand, like Coca-Cola, becomes a safe harbor in a sea of overwhelming choice. They don't have to be the best. They just have to be the easiest mental choice. Then, the powerful emotion of regret aversion seals the deal. We are highly motivated to avoid the painful feeling of regret that comes from making a bad decision. This makes us incredibly risk-averse when it comes to choices where the outcome is uncertain. When a business manager chooses a major software provider, they have 2 options. They can choose the industry leader, like Microsoft, or a smaller, up-and-coming vendor. If they choose Microsoft and the project has problems, they can say, well, we chose the industry standard, these things happen. Their personal career risk is low. But if they choose the small vendor and the project fails, the blame falls squarely on them. they will be filled with regret for taking the risk. The fear of that potential regret is a powerful motivator to always choose the safe, established option. Coca-Cola is the ultimate no-regret decision for a store owner. No one will ever complain about it being there. Any other choice carries a small but real risk of customer regret, and by extension, owner regret. Companies with dominant brand names and long track records are, in essence, selling regret insurance. They are selling an escape from the psychological burden of a difficult decision. This is a subtle but immensely powerful competitive advantage. So how can we, as retail investors, develop the CEO mindset to quantify this psychological moat? We need a mental model. Let's call it the cost of being wrong calculation. This is a framework for looking at a business from its customer's perspective and assessing the true risk of switching. Step 1. Identify the job the customer is hiring the product to do. Clayton Christensen's jobs to be done theory is useful here. A customer rarely buys a product for its features, they hire it to do a job. The job of Coca-Cola is not just to quench thirst, it is to provide a moment of predictable pleasure and comfort. Step 2. Define the consequences of failure. What happens to the customer if the new, alternative product fails to do that job properly? For the restaurant owner who switches to Sparkle Cola, the consequence of failure is a lost customer. For a business that switches its cybersecurity provider, the consequence of failure is a catastrophic data breach that could destroy the company. For a surgeon choosing an artificial heart valve, the consequence of failure is the death of a patient. The more severe the consequences of failure, the higher the uncertainty penalty and the stronger the moat of the incumbent. Step 3. Assess the difficulty of evaluating quality beforehand. How easy is it for a customer to know if the new option is good before they commit? For a simple product like a pencil, it's easy. For a complex service like enterprise-wide financial software or wealth management, it's almost impossible to know if you've made the right choice until years later. The harder it is to evaluate quality up front, the more customers will stick with the proven, trusted brand. By systematically analyzing the customer's cost of being wrong, you can gain a much clearer picture of the power of a company's brand and its ability to lock in customers through fear and uncertainty. The antithesis, the path of the 99%, is to focus only on the tangible features and price of a product while completely ignoring the customer's perceived risk. This is the engineer's fallacy versus the investor's reality. An engineer might design a new type of bolt that is 5% stronger and 2% cheaper than the standard bolts used in aircraft manufacturing. They might believe they have a world-beating product, but they will struggle to sell a single one. Why? Because the aerospace engineer who has to specify the bolts for a new jet engine is not trying to save 2%. They are trying to avoid a plane falling out of the sky. Their cost of being wrong is infinite. They will choose the bolts from the company with a 70-year track record of flawless performance, every single time. The uncertainty penalty for trying a new, unproven supplier is simply too high. The 99% investor looks at the new bolt company, sees its superior specs, and invests, expecting a disruption that will never come. The sophisticated investor, using the cost of being wrong calculation, understands that the incumbent's true product isn't the bolt, it's the 70 years of certainty. This is a crucial lesson for anyone involved in stock picking or for entrepreneurs trying to break into established markets. You are not just competing on your product's features. You are competing against the incumbent's accumulated trust and the customer's deep-seated fear of the unknown. The direct financial connection of this psychological moat is immense. The most obvious result is a dominant and incredibly stable market share. The default choice rarely loses its position without a major self-inflicted wound. This market leadership translates directly into economies of scale in purchasing, manufacturing, and distribution, which in turn leads to higher profit margins. Second, it allows for premium pricing. A brand that represents certainty and eliminates risk can command a higher price than a generic competitor. People are willing to pay a little bit more for peace of mind. This brand equity is a hugely valuable intangible asset that shows up on the balance sheet and contributes significantly to the company's book value. Third, these businesses are exceptionally resilient during recessions. In times of uncertainty, people don't experiment. They retreat to the safety of familiar, trusted brands. Coca-Cola's sales are remarkably stable through economic cycles because it is an affordable, comforting routine. A portfolio built with a core of these certainty businesses is a portfolio designed for stability and consistent, long-term growth. It taps into the most powerful and predictable forces of human nature, our laziness, our fear of regret, and our longing for a predictable world, to generate a stream of recurring revenue that is the bedrock of achieving true and lasting financial freedom. You have just spent this time not merely watching, but actively rewiring your own mind. You have installed a new and powerful piece of software into your investment thinking, a new lens through which to see the entire world of business. It is the switching cost lens. Before, you might have seen companies as collections of products and balance sheets. Now, you see them as fortresses or open fields. You can now look at a business and immediately begin to assess the height of its walls, the depth of its moats. You can see the invisible chains of the financial handcuffs, the sticky pull of the procedural quicksand, the beautiful prison of the technological ecosystem, the unbreakable bond of relational glue, and the paralyzing fear of the uncertainty penalty. This is a permanent upgrade. This tool for identifying durable, predictable, cash-generating businesses is now a part of your mental arsenal, forever. You have acquired a genuine, sustainable competitive advantage over the 99% of market participants who are still chasing headlines and fleeting growth. But here is the critical truth that separates the serious student from the casual observer. The system of thought that Warren Buffett has built is not a collection of isolated tricks. It is a network, an interconnected web of mental models that support and amplify one another. Mastering the switching cost moat is like learning to identify the strongest castles on the map. It is an absolutely essential skill, but it is only the first part of the strategic equation. Knowing which castle is strongest is not the same as knowing the right price to pay for it, or the right time to strike. The switching cost model tells you times what time to buy, but it must be connected to other models that tell you times when and at asterisk what price. The video that is now appearing on your screen is not a random suggestion, it is the next piece of that map. It is the logical and necessary link that connects the fortress you have just learned to identify with the other core pillars of a truly successful investment philosophy. Think of what you've just learned as the foundation. The video on the screen is the first wall that will be built upon it. It could be the principle that allows you to calculate the intrinsic value of that fortress, ensuring you never overpay. It could be the psychological model that allows you to act with courage and conviction when the market, in its temporary madness, puts that fortress on sale. It is the missing link. Most people will stop here. They will feel satisfied with the powerful tool they have just acquired, and they will click away, leaving their mental arsenal incomplete. But for those of you who are truly serious about this journey, for those who are committed to building not just a portfolio but a new way of thinking that can lead to genuine financial freedom, the path continues. The choice to click is not a choice to watch another video, it is a declaration. It is a choice to continue your ascent, to complete the blueprint, and to build an intellectual fortress of your own that will serve you for the rest of your life. The next piece of the puzzle is waiting. Continue the ascent,